I can see on Twitter and on YouTube and all over the place that everybody's struggling with these financial markets. How the hell do we invest? How do we make sense of this world? It's too complicated. There's too many things. What the hell is a yield curve? What does it mean to me? How does inflation play into my portfolio? These kind of questions are really important, and they remain unanswered to this day. And that's why we've done something very different at Real Vision. We've actually decided to solve that problem at scale, affordably for everybody. That is the Real Vision Academy and the Real Vision Investing course. We've created this incredible structured course so you can truly learn how to navigate financial markets and become a better manager of your own portfolio, your own wealth and your own destiny. These are so important. The other thing about the courses that you find online, not only do they charge you a fortune, but it's basically done by somebody who's got no experience in financial markets. This is different. This is built by the head of proprietary trading at Goldman Sachs Equities in London, who also worked with me at the GLG Global Macro Hedge Fund, Lex Van Dam. We took his incredible course, which he trained people for the BBC show $1 Million Traders, and turned it into something truly spectacular, taking it to when Lex never dreamed it could go. Now, Real Vision is always a little bit different as well. We don't make learning boring. I mean, we've filmed some of these videos in extraordinary places like bunkers underground to pubs. We want to make it feel natural, interesting, immersive. So when you come out the other side, you are a better investor. If you join us now, you get an incredible discount. Go to realvision.com/the academy. See you there.
Hi, everyone. Welcome to the Real Vision Daily Briefing. It's Thursday, July 28th, 2022. I'm Maggie Lake, and here with me is George Goncalves, and we are going to try to unpack why the day after a Fed rate hike with the U.S. in or on the brink of recession, U.S. stocks are rallying at the same time that bond yields are falling. George, I'm so happy you're here to sort of help us make sense of this, because we had another 1% gain across the board for U.S. stock indices after a monster rally yesterday, and the 10-year U.S. Treasury yield down to 2.6%. So what do you make of this market action? What is it telling us?
Well, great to be back on, and it's definitely a confusing and maddening market, to say the least. Look, we're experiencing this kind of what you can characterize as a relief rally. You could also characterize it as perhaps the Fed now will come back and save the day, because we've seen things get so bad that eventually this forces the Fed to stop in its tracks, or maybe even have to unwind some of these hikes in the near future. I mean, to me, that is very wishful thinking on the part of the market. But there is an element of the connection which is very mechanical, especially within the tech stocks and the rates market. These are long duration assets, with the 10-year rate rallying as much as it has, and the curve maintaining its inversion, and rates heading lower, is making stocks again a little bit attractive on a relative basis, but also this kind of discount factor argument and long cash flows inside tech companies. That's really, I think, what's at the crux of what's behind this big move in the last 2 or 3 days.
Yeah, and I think you're right. We hear a lot of people talking about the Fed pivot. It does seem that people have sort of played out the things they think are going to happen based on some of this data that's come in, decided the Fed's going to have to abandon this aggressive stance, and they're kind of front running all of the things that implies, as you just said. Let's start with some of the factors in those assumptions. We had a negative reading on GDP, right? The big growth measure today, but we saw Janet Yellen, U.S. Treasury Secretary, President Biden, both coming out. I mean, all over Washington, the political narrative is like, whoa, 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 we're not in recession. It's not that bad. Don't just look at that minus side in front of the number. Where do we know, or what are you looking at to try to figure out, putting that politics aside, whether we're in recession, how severe it's going to be? I mean, what is the growth picture that you're looking at?
So look, I've been pretty pessimistic all throughout 2022 and heading into this year. I thought the growth slowdown would happen more towards the back half of the year, but nonetheless, we've gotten basic confirmation this is a weak year, and it's a reflection of a boom bust cycle, a very classical kind of lot of growth, kind of sugar high that we had in late 2020 into 2021, that you kind of give it all back and then some, which I think is what the process that we're going through right now. And it's led to, at a minimum, shallow growth and weaker than expected. That's number one. And look, we could be technically in a recession, there's a lot of moving parts that go into calculations of the GDP. I'm not going to defend one side or the other. I do think that growth is definitely weak and has been decelerating for quite some time. It sets us up for a really bad second half, though. And this is the part that I'm going to emphasize again, that the Fed is not coming to the rescue anytime soon. In times past, whenever we get like evidence of weakness, everyone could always bank on, well, the Fed will eventually either cut rates, do QE, do something to kind of come in and save the day. And also the U.S. government would figure out some sort of stimulus measures to kind of also backstop things as well. We're not going to get either of those, and we're still reeling from the strong dollar, and rates are still generally higher, and credit spreads are still higher. I think we're moving from the rate shock period to the credit shock period, which will happen in the second half into the early part of 23, and growth will then I think we get a proper recession, not this technical, like this whole, going back and forth and debating the technical recession. We could very well be in one, or some very shallow period once we get the numbers all figured out. But I'm more concerned about the outlook, not so much what happened in the rear view mirror. And the outlook does not look that great. Like where's the catalyst for upside? And no one really has a good answer for me.
Yeah. And I think it's really important. And for those of you who didn't get a chance to listen to Lynn Alden and Luke Roman's conversation on the platform, there are leading indicators and lagging indicators. And some of this stuff lags. I know people pointed to the labor market. It's so tight. How can you have a recession when you have, unemployment at 3%? Do you worry that we'll start to see a lot of that stuff that still looks strong roll over? Certainly, you have a great one. I don't know if we're going to be able to get it up in time, but certainly the U.S. consumer is not fooled by any of this, because people went from searching madly for inflation to now searching madly about recession. Nobody wants to lose their job. I mean, we all have been through that. Everybody went through it, with COVID. Job security is a real thing, and I don't think people are nervous about that.
Yeah.
When will we see all that growth roll over?
I mean, let me pull up slide 3 if possible. Slide 3 is, again, a view of the unemployment rate, and then a 12-month change, which is the black line underneath of the rate of change of the actual unemployment rate. And whenever that line goes up about 0.5% from the local lows, which is basically where we are now, which would put the unemployment rate at 4.1, then that might confirm that we're in a recession, but it won't stop at 4.1. It'll probably end up going to 5.5, 6. I don't think we're obviously going to repeat the COVID shock. I mean, I don't think that's happening anytime soon. But I mean, a garden variety recession that lasts, for a little bit longer, that goes into 23 is more likely, and we have a 60% probability of that. And with today's numbers, that kind of skews it more to the upside. That we're starting off from a very relative weak base. Yes, labor market is strong, but it's also, we're making up for the lost jobs that were lost during the pandemic and bringing it back online. So we're not really fully backfilling things in the way that should be. We should have produced even more jobs, if this was a proper, really healthy recovery. And so I'm nervous about that. It's like that we're cheerleading and touting, like, well, we've created all these jobs. Well, we just put people back to work that used to be working anyway, or they've shifted their focus and skills to some other area. But nonetheless, we're getting the overall labor force participation rate to where it should have been, and even that is lagging. So I feel like, yes, jobs market will have to turn, and that will be probably a Q4 or Q1 experience, and then people will really believe it's a recession, and then that's where the rubber hits the road, and then you get but look, we're going to go through various cycles. Markets love narratives and short-term stories to make them feel good about what their decisions are, and we're going through this little bear market rally here. But I feel like as we get the proof positive that this truly is rolling over, there's nothing that's going to save the economy unless we clean up some of this bad credit. Then the latter half of 23 will be a good, hopefully a better time period. But I think we're still rough sledding ahead.
Yeah. So Jojo asked an interesting question, and I think we're talking about this right now. What do you do when the price action and the data disagree? I'm going to add to that a little bit. It's the confusion we talked about at the top. People see the stock market rallying and they think, oh, okay, we're all thinking, is it bottomed? Should we be getting in? Why is important for people who are listening who may be primarily invested in equities or in crypto? Why is it important to pay attention to the bond market right now? I mean, it's a little biased because you're a bond guy. I'm asking you that, but why should we be paying attention to that drop in yields and what the bond market's telling us?
Look, the bond market is still signaling that there's some uncertainty around the macro outlook, and that it's not clear that the Fed can actually turn the corner just quite yet. And on top of that, actually, the bond market is quite relieved in saying, well, this aggressive Fed is, really proving its inflation credentials, and it's going to continue to go, and that might invert the curve even further. But the Fed has control of the short end; they can lift rates as high as they want. That's just going to further make the recession worse down the road. And so the bond market long end investors are actually taking some solace in saying the Fed is doing its job. But that means that the risk is that the growth outlook is going to get even worse from here, not better. And that's something that I think risk market investors are not quite understanding or used to. The Fed only pivots when they really, well, one, we've had not an inflation problem going into a slowdown, and that's very unusual for markets to understand and get their heads around it. And the Fed hasn't stopped yet, and the inflation problem hasn't turned the corner yet either. We're trying to guess those three things and trying to pinpoint that the Fed will blink and therefore save the day. And we can't guarantee that until we know that we've gotten through the inflation story and we know that growth either has bottomed or will continue to worsen from here.
I want to put up a tweet that that Real Vision CEO Raoul Pal put out today. It's a chart. He also, as everyone knows, really closely watches the bond market, and he put something out. It's quite technical, but it showed bond yields breaking below what is a head and shoulders pattern. And you could see it. That's why they call it that. I mean, you could see it. It looks like that on the chart. But and he's pointing out that that is an indication that growth and inflation expectations begin to fall. I'm going to ask you if you agree with that and push back a little bit on the inflation part. I think we just covered why the growth outlook is slowing, and maybe some of the indicators that look good are still lagging. What about that inflation part? Where is the evidence that that's going to roll over in the same way growth is? Are bonds telling us that? And is there a risk that that doesn't happen? Because I think this is where the big debate between especially the commodity folks, but those in the sticky inflation camp and those who are not really disagree on how persistent is that inflation. Are you seeing evidence that inflation is going to roll over?
Like I was just saying before, the bond market, again, not just in terms of the treasury market, but the tips market, the inflation expectations that are implied thereof, and inflation swaps, all of the smart money around inflation markets are saying that, hey, inflation is coming down. And in fact, actually, the break evens, these spreads between treasuries and tips have compressed a lot. So the bond market is giving a signal and a good report card to the Fed saying that you're going to do your job because we believe you. Now, again, this is a similar situation like we saw at the beginning of the year. We price things in before they actually happen. So like we priced in the massive hiking cycle before the Fed delivered them. And now we're pricing in the Fed's gonna have to cut them, take them back. And we're also assuming that they're gonna win the battle on inflation. And that's what the tips market is saying. It's possible the bond market might get it wrong. I mean, I think we're generally right in the right direction, but it's gonna be a very ambiguous period around which part of inflation is going to head lower. Because yes, some of the higher frequency in the commodities markets will probably turn faster if indeed the economy is decelerating more, and growth and all that globally could come off, and that will help bring down commodity inflation. But the food inflation is a little bit sticky. The Fed mentioned it also yesterday. That was I think something very noteworthy to kind of point out, that they're focused on inflation because that hits everybody, and not just energy commodities. And then there's the owner's equivalent rent, and just overall rent and housing inflation operates at a huge lag. So this is very ambiguous period that we won't know for sure until like Q1 of next year. And that's a lot of ground to cover for people to get bulled up on any asset class between now and then.
Yeah, that's a great point. I think that Jim Bianco and Joseph Wang had a conversation yesterday. I think it aired today on the platform. You can go check it out, the full interview there. But Jim was expressing concern that about the level of bond market volatility that we've seen, right? We're used to equity market volatility. When you're looking at bonds, they don't usually exhibit, at least over long periods of time or months at a time, this sort of same kinds of swings. We don't expect that. I mean, he's noticed it and he's concerned about it. Let's have a listen to that clip from that interview.
And I agree with you as far as up and down the line, you look at measures in the bond market and you could argue that it is somewhat dysfunctional. Whether you look at realized volatility, look at what's happening in the bond market right now. We could go 24-hour periods with 20 basis point moves in the bond market. Pre-COVID, the 20 basis point move was like a special show on CNBC with no commercials for an hour. Oh my God, look what's happened in the bond market. Now it happens twice a week, and no one notices anymore that the bond market does this. Measures of bond market implied volatility like the MUFG have not hit all-time highs, but have been in the upper 5% of the numbers we've seen in the last 30 years, equal to where they were in the spring of 2020. So the total return losses, I've tweeted that chart out many times, is at an all-time record for 2022 for the bond market. So it is not in a good place. I would nuance what you said that, things break. I've said things have already broken. The bond market, you might argue, is broken. I would argue that the energy markets might be broken as well, too, with the way that they trade. The stock market might have already broken. It already had a 20% correction. So maybe it's not that the Fed raises rates until something breaks, which was the old line. It's the Fed will keep raising rates till enough things break, because we've already broken some things.
So, by the way, that is a sneak peek. That is hitting the website right now, so you can go check it out. So, George, is the bond market functioning properly?
Well, listen, I mean, liquidity has been challenging for quite some time. This year, the first half was, a multi-flood, terrible year in the bond market. I mean, we've never seen losses like that ever. And that, to be expected, we were going from such low rates to a big increase in rates. That's why I referred to in the beginning, the rate shock happened. That was the first half of the year. And that, is still reverberating through the system. Don't get me wrong. It's still going through the system. Even though we've seen rates come back down here, this kind of back and forth has created a lot of confusion. And also realized volatility has remained very high. And when that happens, people take down their balance sheet risk exposure. And by doing that, that means you can only trade so much in terms of size. And so sizes of trades get smaller, people get more defensive, and it creates more of this kind of back and forth two-way price action. And that does amplify some of the moves that we're seeing. There's a measure on Bloomberg that looks at overall liquidity, which is a pretty good one. And it's looking at the dispersion between old treasuries and new treasuries. There's a preference for new treasuries. They're the bigger benchmarks. They're more liquid. You can trade them more actively. This dispersion actually just made a second or third high. The worst case was COVID, but that was a complete dysfunctional time period. The other time was right before the Fed started hiking in 2015. And so, the market is definitely the bond market is definitely under pressure. Liquidity, is definitely at a premium, and that's leading to, very challenging trading environment for sure.
Do you think we're going to see continued volatility now that the Fed has basically said they're data dependent?
That's a really good question, good point. And I think so, yes. Because now we go from we're not on cruise control.
Yeah.
And you go from you need to really understand where the data is going to, and no one has a crystal ball, including myself, and we just don't know. But we have our assumptions, we have our kind of basic thesis on where we think we are in the cycle. But as each new data point comes out, it's gonna force one side of the boat to go to the other side of the boat, and we're gonna keep kind of swaying back and forth until we get some certainty that we either have or will dodge a recession, or if not, how deep will it be if the Fed doesn't pull back. And then we're going to start to guess, are they going to start shrinking the hikes? So they went to the 75, which is really large by historical standards. Do they go to 50? Do they go to 25? What makes them pause? We're going to be second guessing ourselves for the next 3 months, at least 3 to 4 months, up until the midterms, quite frankly. I think this is just going to be par for the course. And we should that's why I feel like if rate vol is high, eventually it's going to expose equity vol too, and FX vol, and then you get this more of a macro picture where people cannot just be on one side of the trade and just stay long only. This is going to be a trader's market.
We're going to mind that in 1 second, but we have a great question from Ralph. What does George make of the fact that bond investors would have been better off holding the junk bond ETF versus the TLT year to date in terms of price?
Look, I mean, actually, high yield has a decent amount of duration component too. So you are taking advantage of that sort of kind of rates rallying back is also helping out high yield by extension. I don't think there's much to think about it. I mean, I am still nervous about credit. I haven't changed my view on that. So I think, again, these are, potentially bear market rallies. We'll see if they have legs or not. But I think it's maybe a better trading vehicle, but maybe not necessarily a great investment yet.
Ralph is asking that question because junk bonds, which are really high yielding bonds issued by companies that are thought to be riskier, you get paid more for buying their debt because there's a higher risk they will default. It's a very liquid, well-established market, but that's why it's called junk. Versus the Treasury, which is supposed to be rock solid haven, and that's why he's asking. It seems weird that something in this environment that's riskier would outperform. I think you just gave a great explanation as to why it is. It's been benefiting from the sort of bear market rally that we've seen. Are corporations, is the corporate bond market better positioned in any way, George, to weather this? Are you looking at that? What are you recommending in terms of portfolio in this environment?
So actually, the corporate bond market, broadly speaking, even high yield in some areas should be able to weather if we have a garden variety recession, something akin to the late 80s, early 90s, or early 2000s coming out of the dot-com period, especially because during the COVID period where money was cheap and rates were low and spreads were super tight on credit bonds, corporations issued a ton and took advantage of funding. And so corporate America, I'm not as worried about. I'm much more concerned about the smaller, mid-sized companies that might have a difficulty at actually getting credit. But that's where you get a typical recession, is that it's the haves and have-nots between credit, and the corporate bond market should be able to weather that storm.
I want to return to this issue of inflation because I think this is really, really puzzling people. And we know, by the way, we talked about the Google search with recession. We know the reason that, Washington politicians everywhere are doing their best to bat away these questions because inflation was the big issue. I mean, it may end up costing people their seats because Americans have been hit so hard, but everyone around the world has been really struggling with the high cost of fuel and food and everything else. You have some charts that are really interesting in terms of how quickly inflation can come down. I asked you that before, but I want to look at these charts. So you have one that's headline CPI versus PPI. So consumer prices versus producer prices. What is this telling us? Why is this something that you're looking at?
Yeah, I think this is a great chart to think about, especially for the Fed's reaction function, and then how does the economy at large react to future price increases. And so this is a lot of history. This goes back to the 1970s. If you look at the beginning of the chart, that you'll notice that the red line, which is the PPI, and just overall kind of what companies are paying in terms of their input costs, were rising much faster than consumer prices back in the early 70s. But then there was a recession in 73, 74, 75 that pulled back down, which is again evidence that recessions do kill inflation. So you want to fix inflation, create a recession, you'll get it down pretty quickly. But what happens is the echo or the second or third waves can get worse. So if you don't really fix the inflation problem and all you did was just temporarily brushed it under the rug, then you create the problems for a bigger inflation wave down the road. And that second wave that I've circled there in green is when corporates start to raise prices at the same speed as consumer prices. The prices that they're getting from their cost of inputs, they're passing them along to the consumer. Then you get into that kind of that spiral where consumers demand more wages, and then kind of feeds on itself. Like that's when you get this kind of more permanent inflation, and that's when the Fed has to go even harder. So that's why when Chair Powell was saying that price stability matters more for the long run success of the job market and a healthy economy, he's actually being very honest, because if you don't get inflation under control, it's going to come back. You can't just push it away. I think that people have gotten a taste of what inflation looks like, and if we get to a point where we start giving out easy money again, people are going to start to just create this mess all over again. So that if you maybe move to the next slide, if you don't mind, page 6, which is built on this same concept but a longer look. I have these little gray bars overlaying the CPI as well as the Fed rate, which is in blue, and then the underneath at the bottom is GDP, which is the black line. And so you can see those gray bars, which are recessions. Whenever you have really high inflation like we did in the 70s through the early 80s, then you get a GDP decline, the Fed hikes rates too much, you get a recession, and then you kind of do that over and over again. It took 4 recessions to really kill inflation from the 70s into the early 80s. I don't think anyone wants to repeat that.
So if you're the Fed and you're looking at that, I mean, it would explain, I suppose, why they're trying to aggressively front load those hikes, and tighten to try to make sure that they get it early so that they don't have to have 4 recessions in order to tackle it, correct?
And also means that they probably won't come to the rescue if stocks were to ever come down again, because they're going to have to keep rates high.
So what I'm looking at, that doesn't look like that's priced in the market for the last 2 days.
No, it's not. This is just a short-term relief rally. We'll see how it goes.
So that's really interesting. Why do you think, if everyone's looking at this data, that people are getting so ahead of themselves thinking the Fed's going to pivot? Have we just been trained that way in the last period of Fed monetary policy, that is what happens?
Yeah, there's that. I mean, I think the whole FOMO concept has not really been put to bed either. So there's still, and it's still a traders type market. And we're in the middle of summer and we're going into August. I feel like this is more just market, trading, not necessarily big long-term view or bet here.
And that you're talking about that in terms of equities. Is it the same for bonds?
To a certain extent as well. Because, I mean, there's a limitation to how much 10-year can rally if the Fed is not done hiking yet. I mean, yes, they can invert the curve even more so, and that's completely possible. The Fed can do whatever it wants with the front end. But at some point, there's going to be a disconnect between if the short-term rate's at 3.5%, 4%, and the 10 years at 2.5%. That doesn't make any sense. So, eventually rates will lift up with it, and then you get that, the last bigger sell-off in end of third quarter, fourth quarter. Markets realize the Fed means business, regardless of the actual growth data, which again, we won't have full proof until deep in Q4 and early Q1 if we are in a recession that's much more binding. And so, like, you can't have it both ways, basically. And so I think that's when the markets will wake up and realize, again, if they don't wake up sooner, we have Jackson Hole in at the end of August. We have the September meeting, which will be also important. We have a couple inflation prints to get through. It's too soon to say that we've completely won the battle or won the war on inflation. Maybe we've won one battle for now.
And it's interesting because do you worry that when you see risk assets rallying, we did just get a little bit of fiscal something passed in Washington, that it sort of undoes what the Fed is trying to do in terms of inflation expectations? Are the markets working against the Fed right now with this rally?
Well, listen, again, Fed's tools are very blunt, and they ultimately come down to a version of financial conditions tightening. And so the market just eased for the Fed, both on the rates side as well as credit and equities. So we know now the Fed has to work a little bit harder if they truly are trying to get at aggregate demand gets completely driven and keyed off of wealth effect. People feel wealthier, they will start to spend money again at a time where we still have supply chain constraints and the risk for inflation to kind of reflare up again. That just makes the Fed's job even harder.
I want to get to one more chart you have, because it's anytime I see warning, I want to put it up. And this is the dollar. Annual change in DXY, a warning. Talk to me about this chart.
Yeah, this is a chart, great chart from our FX team, and we're just basically highlighting each time we've seen a very sharp and fast rise in the dollar, something breaks around the world. We don't know what, because obviously if we did, we would not be here talking to each other. We'd be on an island somewhere. But nonetheless, I mean, something usually breaks. We're a dollarized world, and dollars are still in high demand. And there's all these weird things happening on right now. You look at the reverse repo program at the Fed, all this extra dollars are sitting at the Fed. It's just something's up with the dollar. I don't think, even if the Fed expectations were to completely unwind, which I think they won't, there's demand for the dollar. So I think that the whole dollar wrecking ball that people have as their theory, I think it's true. And we have not had that cathartic moment yet. So if we have the cathartic moment of one bigger final flush, the dollar will probably rally, to new highs, or maybe at least stay at these high levels for a while.
And then look out, because when that happens, as you can see on your chart, all hell broke loose. Any area that you're particularly worried about the dollar taking out if it's a wrecking ball this time around? The problem is, as you said, it's very hard to forecast where that happens.
I mean, look, I'm still concerned about emerging markets. Anyone that's just borrowed cheaply for the last couple of years that are dollar centric.
You need to be careful. I have to ask this question because the handle is so hilarious. Who sent them to the nursing home on Twitter wants to know, have bonds broke the 40-year channel of lower yields?
So my definition, kind of like almost like an NBER recession view, where like you have to have 2 quarters of negative growth, or a long enough period of weakness to characterize it as a recession. My view is like we maybe have broken the 40-year bond bull market run. My view was we need at least 2 quarters of rates staying above 3%, and right now we're not. So we got above that level in Q2. We stayed there into the close, I think, roughly around that level on average for the quarter. If Q3 were sub 3% and heading lower again, it could have just been an anomaly of what we just went through. Again, short-term rates reacting more to the inflation move than the long-term rates, because the long-term rates know that long-term, the U.S. has structural issues on demographics, as well as just all this debt in the system. It's hard to keep high rates. So I think that you could say at a minimum we're going to go sideways, and and that doesn't mean we enter into a bear market. This idea that you have a bull market for 40 years means you have to enter into a bear market. I don't buy that, because we need low rates to keep this thing going.
That's a great point. It doesn't have to look in that V shape. So if it's been a fascinating conversation, George, and if I'm sort of listening to what you're saying, it sounds like you are way more cautious than a lot of people out there. You're concerned that this is an overreaction by the market, both equities and bonds. The Fed does not have a cape on. They are not going to come to the rescue. They may still be more aggressive than we anticipate. Inflation is still a problem that's got them handcuffed. Is that a fair
That's a great
assessment?
That's
Yeah.
a summary.
So what is cash the recommendation under those circumstances? Is there anywhere to hide for this sort of realization that everyone's mispricing everything right now?
No, look, I still think I've been saying this, the very front end of the credit curve offers you yield. Even front end treasuries offer you yield for the first time. They're not necessarily cash, but they're close enough to cash. And you look for anything that's yield and high quality. Mortgage related products also look interesting. They had a really tough first half of the year. These are high quality liquid fixed income portfolios. Like that's where you need to weather the storm. And then if we'll see how the risk markets behave in the coming months and quarters. There's gonna be values to be had going forward. I just don't think you should chase the market.
Some sound and sage advice. George, it's been an absolute pleasure. Thank you so much for being with us today.
Great to be here. Thank you.
We're going to keep the conversation going. As George said, these are really complex markets to go through. We've got another in our special series this week. Raul caught up with David Rosenberg. They're going to be all over the bond conversation, as well as the daily briefing tomorrow. Andreas Stena Larsson's going to be back with Jim Bianco, so you won't want to miss that. Thanks to all of you for watching. Take care and good luck out there.
I can see on Twitter and on YouTube and all over the place that everybody's struggling with these financial markets. How the hell do we invest? How do we make sense of this world? It's too complicated. There's too many things. What the hell is a yield curve? What does it mean to me? How does inflation play into my portfolio? These kind of questions are really important, and they remain unanswered to this day. And that's why we've done something very different at Real Vision. We've actually decided to solve that problem at scale, affordably for everybody. That is the Real Vision Academy and the Real Vision Investing course. We've created this incredible structured course so you can truly learn how to navigate financial markets and become a better manager of your own portfolio, your own wealth, and your own destiny. These are so important. The other thing about the courses that you find online, not only do they charge you a fortune, but it's basically done by somebody who's got no experience in financial markets. This is different. This is built by the head of proprietary trading at Goldman Sachs Equities in London, who also worked with me at the GLG Global Macro Hedge Fund, Lex Van Dam. We took his incredible course, which he trained people for the BBC show $1 Million Traders, and turned it into something truly spectacular, taking it to when Lex never dreamed it could go. Now, Real Vision is always a little bit different as well. We don't make learning boring. I mean, we've filmed some of these videos in extraordinary places like bunkers underground to pubs. We want to make it feel natural, interesting, immersive. So when you come out the other side, you are a better investor. If you join us now, you get an incredible discount. Go to realvision.com /the academy. See you there.